All right, it looks like we're live. We're currently broadcasting to YouTube, Facebook, and Twitch. Welcome to Millennial M1 Money. For my newest viewers, M1 is the financial term for cash or money. If you haven't watched my other videos on wealth or poverty or accumulation of wealth, check them out. So we always start the same here on Millennial M1. Stating the obvious, intelligent people avoid instant gratification. That is the best way to accumulate wealth and to avoid spending pitfalls. On that note, 2019, I'm going to have a New Year's resolution. I'm going to try to up my personal savings rate to 83.3% of my take home pay. Gulp. Just a comment on that. The marginal propensity to save is 10%. You're asking yourself, what is the marginal propensity to save? That is what everyone saves on average, whether you are young, old, short, tall, doesn't matter your nationality or your origin, rich or poor. On average, people save 10% of their take-home pay. So if you're doing more than 10%, you're doing a good job. My New Year's resolution is to ratchet up to 83.3% of my take home, and we'll see if we can do it. Stay tuned for that. Also, we like to start with a quote from Warren Buffett, the Oracle of Omaha. I was watching a nice video today, and he basically, to paraphrase, you don't have to be a good investor in every industry. Invest in what you know. For example, Warren Buffett is famous for investing in Coca-Cola, power companies, insurance companies. Buffett doesn't need to invest in Amazon or tech companies because that's not his specialty. It's really important to really understand that Warren Buffett didn't miss out on an opportunity by not investing in Amazon. He invested wisely into industries that he's very comfortable with, that he can understand from a fundamental and a technical perspective, and he's done very well. And he has the luxury, and he doesn't need to invest in other industries. And it goes the same for you and goes the same for me. Whatever your industry or your specialty is, focus on that and invest in what you know. All right, so the question of the day, I had an individual approach me, and we'll go ahead and say their name is Daniel for the purpose of this conversation. And Daniel said to me, I've got $20,000 that I have saved up, and I want to know what to do with it. I've got a wife that's 5 months pregnant, and he provided a few options for me. He said, should I pay down a school loan to reduce my debt payment from $500 a month to $200 a month? Should I pay down my mortgage, or do you have better ideas? My gut reaction to that was, first of all, I strongly believe that mortgage debt and student loan debt is good debt. I don't believe in paying those down faster than the minimum payment. We can go into that in another conversation, but there's something called the cost of capital, and it's a fundamental term in finance, and basically it means with your $20,000, if you gave it away to your school loan debt or to your mortgage, what would your return be? Oh, you'd probably pay a little bit less interest, and you could do the math on that. Or if you put that $20,000 to work as an asset, not to decrease a debt payment, could that asset that you invest in make you more money than the alternative option of the debt paying down the mortgage or the school loan? So a couple of things that come to mind: stocks, bonds, short-term treasury bills, cash. So first of all, right now, my suggestion would be to not just part ways with $20,000 cash, because liquidity is very important right now in this economic cycle. We're going through a downturn. I would not put any money into stocks or bonds. I would, or corporate bonds. I would put money into short-term treasury bills, one-year bills, where you get anywhere from a negative 1% to a 2% return, or save it as cash, even though you're losing 2% due to inflation every year. So saving money as cash is not a good long-term investment strategy. However, right now, cash is the most important thing to have on hand right now, because over the next 12 to 36 months, we're going to see some continual contraction in the market, and it's going to open up opportunities for additional housing. When housing softens up and when the market drops, you could it's not wise to try to time the market, but there are a lot of indicators telling us that the market is going to go down further. We have not yet seen an inversion of the treasury yields of the 2 and the 10-year note. So wait for that and then put your chips in. So we'll just go ahead and end this podcast today with market analysis. The Federal Chair Powell is not in favor of keeping debt at $4 trillion. He wants to lower that possibly as much as $600 billion. So basically, we can expect that the Federal Reserve is going to continue on their path of preventing what you could call inflation and acceleration in the economic cycle. And I agree with that, with the Federal Chair. I think they need to rein it in right now. And as intelligent investors, we can expect the market to go down still. Short term, we're seeing market gains, but when the chickens come to roost, that's when we see the Treasury yield curve invert, and that's when we start to think about putting our cash to work for it.